Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is November 19th, 2025. And today on our call, we have back the CEO, Benjamin Urban from DIRTT Environmental Solutions. DIRTT trades on the TSX exchange under the symbol DRT, and it also trades on the OTC under DRTTF. The company is currently trading at 99 cents with about 191.5 million shares outstanding, or give or take a $190 million market cap. I'd now like to hand it over to Paul Andriola.
Trevor, thanks a lot. Benjamin, good to see you again. It's been a little while. Happy to have you back here. We were just trying to figure out exactly how long ago it was that you were here. So it was either, I'm going to say 9 to 12 months ago. So more than overdue to get an update here.
Yeah.
Before we jump into the update, why don't you remind everybody what DIRTT's all about?
Yeah, good to see you as well, Paul. So DIRTT, we are industrialized construction manufacturing. We're based here in Calgary, is our HQ. We're about 850 employees globally. Predominantly, the majority of those are in Canada and the United States. We have about 500,000 square feet under roof of manufacturing here in Calgary, and then another roughly 200,000 square feet under roof stateside as well. About 30% of our overall revenue is in Canada, 70% in the US. And as I mentioned, we are industrialized construction. So what does that mean, right? So we are prefabrication of anything that you would come across in an interior construction inside of a building. So we aren't external. We're not doing core and shell things, but across your verticals, healthcare, government, education, workplace, we participate in all of those different verticals. About roughly half of the Fortune 500 are DIRTT customers. And there's a few reasons for that. So at its core, the value prop, right, is we are technology advanced prefabricated manufacturing. So we have a software company as well called ICE that resides underneath the DIRTT umbrella. But with that, it allows us to do things, and this is the value prop in lieu of building conventionally. And when I say traditional or conventional construction, what I'm referring to is stick-built drywall and traditional carpentry, glazing, and sheetrock painting of that nature. So with DIRTT, there's a few reasons customers choose us as an alternative construction method. One is it could be speed. So if it's a service industry, so healthcare, for example, one of the reasons that is one of our fastest growing verticals is because of speed. So on a large scale, let's say a full hospital, we could actually build that and get open and operating twice as fast. So if it was going to take you 2 years to build a hospital, you could build it in one. It's not the core and shell typically that are the limiting factors in construction from a timing perspective. It's the interiors that tend to drag out. So speed if you're in the service industry, but then also regardless of what vertical you're in, it could be a lease expiration. It could be a business change. Something happened. You have to get out of a building into another. So because of that technology, it does two things. One, it allows us a 10-day lead time with mass customization. So what that means is we don't warehouse any like catalog of products. You don't say, I want one of these and one of those. What we do is similarly to the wall you see behind me, we interpret the design from the architect or the designer, or maybe it is through a general contractor. And then that software translates that into automated manufacturing. So that's what gives us that really short lead time. The other piece of it is schedule compression. So yes, we can manufacture it quickly, but as I was saying, we can decrease or compress the schedule on a hospital by half. A less complex project, so let's say commercial office space, something of that nature, you're usually looking at a minimum of 4 to 6 week reduction in overall duration. So larger customers, CNRL is a perfect example of that. That's pretty much the main reason they chose us for their 1,000,000 square feet that we're building out here in Calgary was schedule compression. They couldn't build it fast enough conventionally. So you have speed, sustainability continues to remain one of our value propositions, not necessarily in how we manufacture. Yes, we have a reduced footprint carbon-wise on the environment, but really more around the circular economy, in that everything that we manufacture is intended to be redeployed, reused, reconfigured. It should never end up in a landfill. Worst case scenario, if some company went out of business and there wasn't a available location to relocate that product to, it is 100% recyclable as well. So it still wouldn't end up in a landfill. Within that sustainability, I mentioned the circular economy. Some of our customers use it because they do reconfigure a lot. And so they could be wholesale, building to building, or it could be in a hospital where you're changing the actual purpose of a exam room from a cardiology room to a dermatology, and they need different equipment or they need different finishes. You can do that overnight. You can actually do it during operations because it is clean construction. So if you were to normally have to shut down a wing of a hospital to do construction because you're going to be sanding, you can actually leave both of those exam rooms operating and do only the work in the one that needs work done without disrupting what's happening on either side of it. There is a financial play as well. So some of our customers, this tends to be more stateside than in Canada. But because it is personal property, it amortizes differently and depreciates differently. It also allows you as personal property to roll it up into a lease finance vehicle if the customer is so inclined. And then the last would be performance. And what I mean by performance, that could be aesthetic, it could be acoustic, it could be a rated partition. One of the things I do want to share that's a recent development from an innovation perspective, and I'll come back to that in a minute, is around operating rooms and some recent wins we've had there. In fact, let me just unpack that a little bit, Paul, and then we can transition to more what's happening in the business and less or so around the value prop. But it's a really good example of what DIRTT can do. And so we have recently begun building out an additional experience center. As I mentioned, we're based here in Calgary. We also have a facility in Chicago that we own that's an experience center. We have one in Dallas, Texas also. We also have one that we've recently begun building out in the Texas Medical Center in Houston, Texas. And why this is an interesting story is that part of our innovation that we've embarked upon over the last 2 years, has been further, I guess, filling out the product portfolio that we have. And really where we used to stop, more so in healthcare than many other verticals, would be at your sterile core or your sterile corridor and kind of what happens behind the scenes. And that's where you have rated partitions that are either fire rated, non-combustible, or some level of performance that we couldn't compete in. We have since solved for all of that from an innovation perspective. And there's I can't name the exact customer because I don't have clearance to, but it's one of the largest ambulatory surgery center customers within the United States, which is under the umbrella of a much larger healthcare system. And so what we created for them was an operating room. And what's compelling about that is through miscommunication, it's part of the reason I like this story. We'll call it not decision maker, but the manager within that healthcare system said, hey, okay, we believe you, the pricing is there, the value is there, but we want to see an operating room because we haven't done one yet. And so we said, okay, they said, we'll just build a vignette so we can see what it looks like at the ceiling, at the walls, at the floor. So we built this. They flew their entire steering committee and CEO to Houston to look at this. They get there and they say, this is terrible. We want to see an actual operating room. We didn't come here to see a wall. And so again, miscommunication. So we said, all right, come back in 2 weeks. So in 2 weeks, without anything to work off of, we built an entire operating room in that space, all the partitions, all the equipment, all the med gases, and said, come back in 2 weeks. They came back in 2 weeks, and it wasn't the details that was what compelled them to say, okay, we're going to start using DIRTT for everything. It was the fact that we did it in 2 weeks and we created something that simply couldn't be created with any other manufacturer. You couldn't have done that conventionally. It just couldn't be done. So in a way, that miscommunication was actually what led us to closing this opportunity. And why it's so compelling for us is just one of those ambulatory surgery centers is about $5 million of product to DIRTT. And they're deploying them all across the United States, and they're part of a larger system. And they do about 100 million in build that would be 100 million to us on an annual basis. So these are examples of things that we couldn't do previously because we didn't have the innovation complete. We also didn't have, and this is where I'm going to get into what's happening in the business a little bit here, Paul. We didn't have what we call construction services. We used to call it integrated solutions. So 9 months ago when we had this call, I talked about this new diversified channel that is effectively direct to general contractors and customers. In the last earnings release, we actually renamed it construction services to better represent what it is that it comprises, that are the services that we deliver. So the space that we opened in tech, in the TMC, the innovation, and this new delivery method allowed us to do something that DIRTT never could have accomplished before. So that's a really good example of what we can do and what DIRTT is. So I'll pause there, and then Paul, you can kind of direct me where you want to go with this.
Well, perfect. Well, I mean, why don't we jump on some of the other updates? I've noticed that over the last little while, you guys have gained some new clients, or maybe some old clients, but you've announced some call them contract wins. Let's talk about some of these others.
Yeah.
I think Google. I saw Google there, and I'm sure there's a few others that
Yeah.
we're
So
talking about.
Google, Micron, let me pause for a second, come back to Google. So, and I'll tie this into our most recent earnings release as well. So where we're quite positive on where this company is going. So the pipeline that we disclosed, and that's our 12-month pipeline. So, excuse me, we'll call that September to, well, actually we'll call it October to October, right? So that pipeline was north of $330 million, which is the highest it's ever been for us. Full disclosure, our Q2 was not great. We burned cash. Majority of that was tariff related. Q3 recovered back to positive adjusted EBITDA, but more importantly, and gave guidance for Q4, which is showing up great from a top line, which will then translate to kind of more normalized, at least for us, what sort of adjusted EBITDA we're putting up on the board. But more importantly to all of that is that 12-month pipeline, right? We didn't disclose any sort of guidance for 2026 yet, but the pipeline being at 330 million, being the largest it's ever been, we also have a 5-year full pipeline that we've been trying to determine how we want to disclose that, because it does give a more holistic view of, okay, great, what is not just Q2 of next year, but what does 2027 look like? And Cormark, that covers us from an analyst perspective, is also begun to kind of tweak their view, the longer view, on what that revenue looks like. Within that, Paul, are some of those big wins. And so we did talk about Google, and they've been a customer of DIRTT's for 10 years. We've done 250 projects with them. And what I like about that story is it demonstrates the stickiness of DIRTT. Many a times, like the tour that you guys got to take, the virtual one through the space here, and for any of you that have actually been to our facility here in Calgary, we usually start with a kind of design around this is how we use that technology. And we've done this with Google and some others. We'll actually design something. We don't know what it is. We say, whatever you want, piece of casework. It could be a wall, could be a door, pick whatever you want. We'll draw it in the software, pick whatever color you want, and we will manufacture it. And the reality is most people don't believe it until it actually happens. And they say, oh my God, I really, truly didn't believe you that you could do all these things from a technology-enabled manufacturing perspective. Once that happens and they do a project with us, it's very uncommon for them not to be a repeat customer. And so the common phrase I hear back from those decision makers is, why doesn't everybody build this way? And the reason is for all the reasons they hadn't built with it before, because they disbelieved that we could actually do it. Once they're living it, those national accounts, and when we did that other healthcare one that I was talking about, are so impactful to us because they become repeat customers. And we can count on that to stabilize some of the peaks and valleys with our demand curve on how we manufacture. And so Google is one of those. Micron, which we've touched on a few times, that is the semiconductor manufacturer that we referred to in the last earnings release. That project is quite interesting in that that started last year, and it started as a $200,000 casework opportunity, so millwork cabinets. And we are now up to $14 million of opportunity on the same project. And so that is also through that direct channel of construction services. And so what we've proven to be true is not only is there opportunity for expansion and top line growth with construction services, but those projects tend to be significantly larger than our traditional furniture dealer channel. So when I say traditional furniture dealer channel, that's where I came from before being CEO at DIRTT. That is through your Miller Knoll dealers, your Steelcase dealers, Hayworth. They also sell DIRTT. And the average project size for that channel is around $50,000. The average project size for construction services is $2 million. And so in reality, if you were to even take half of that, it takes nearly the same resources because we are technology automated to deliver a 50,000 project versus a million project through our actual manufacturing. So that's why it's so interesting or attractive to us is it really allows us to accelerate leaning into that fixed cost leverage faster than if we were to do it $50,000 projects at a time. If we can drop in some Microns, some Googles, some others that I can't talk about, where you'll be able to actually see it. And this is a question that I've gotten from some of our investors is, at what point in time can we separate out construction services from DIRTT as just this one entity? That will be in Q1. So I would expect in Q1 earnings of next year, you will see construction services as its own accounting line.
Fantastic. I mean, you talked some pretty big numbers there. Give us a sense of what's your capacity on an annual basis? What kind of numbers could you do at full capacity?
Yeah, full capacity is 400 million. And that includes the 10-day lead time, right? So that continues to be a North Star for us, right? Is leaning into that capacity, because if it's a longer duration than we expect it to be to take down that capacity, then it would be more prudent to lean further into what we're calling microfactories. I think we might have talked about this 9 months ago, but once we get to 300, 350, we will expand manufacturing, but it will be dispersed, right? We won't build another 500,000. We're 3 different buildings here in Calgary. It would be more around 100,000 square foot at the most in different spots across either the United States or possibly Mexico as well. So right now we have 400 million in capacity to take down.
Mm-hmm. And then just in general, like what sort of, let's say, industry trends affect you guys the most? Like we've seen, obviously, residential construction is starting to really decline. Industrial seems to be increasing. Commercial is kind of all over the place. Is there one sector that affects you more? I know you guys don't do residential, but my point is that it's all over the place.
You're not wrong. It is all over the place. Mm-hmm. And for us, there isn't one specific sector or vertical or macro that affects us significantly. Tariffs clearly did, but we've since adjusted for that. And frankly, we're not alone, right? That's affected pretty much everybody, even as we're watching raw material pricing continue to increase a bit. But for us, from a vertical perspective, there isn't anything that disrupts us per se. However, and because we are such a small piece of the overall construction industry, and so we're able to, Paul, effectively carve out for ourselves our own channel, if you will. And that's where once we get I'll call it further adoption with some of these large general contractors. For us, rather than kind of, I was talking about the $50,000 projects through our furniture partners, this is us focusing on a half a dozen of the top GCs, including Bird and others in Canada, right? They're all just massive. And so for us, they're looking for solutions like ours because they are also experiencing the same challenges, not same, different challenges, right? For them, it is availability to skilled trades. It is availability of raw materials. It's all the things that are constrained for conventional construction, which are all tailwinds for us. It's more around articulating and getting them to adopt, you know what, you're right, we're going to use dirt instead of building this out of drywall. And it gives you all these additional flow through benefits that a Fortune 500 company would get at the same price point as conventional construction, right? And so that's been I'd say the head scratcher is, when will that inflection point happen? And so aside from the tariff piece of it, there really aren't any macro events happening in any of the industry that affects us. It would be tailwinds. And as we continue to see that increase back to work or back to the office migration happening, that's all gravy for us. And so we're not counting on that because it has proven to be quite difficult to forecast when some of these customers are going to go back to the office. So we are very much still leaning in heavily to healthcare and education.
Gotcha. Let's talk about just the financial picture. You mentioned Q2 was a pretty significant bump in the road here. Q3 is a good recovery quarter. How's your balance sheet? What do you need? What's kind of the outlook as far as capital requirements?
Yeah, balance sheet's good. We got over 32 million. So I think what we reported in last earnings release in liquidity. We took care of I won't say we took care of it. We've still got a few steps to go through, but I think the bogey out there that people were asking about was the convertible debentures that are coming due in January. We are finishing up a refi through BDC, such as to basically take down that entire bit of convertible debentures. We could have paid it out of cash. And that was also part of the reason that we didn't delay, but we wanted to ensure that we pursued all options to land in the best place for what do we do with those. So I'd say those are squared away. As far as, capacity, we've got plenty of capacity. We've talked a bit about transformation as well, Paul, in some of the earnings and disclosures. What that means, and let me just kind of unravel that a little bit, is we restructured in 22, 23, right? We got into profitability 24. 25 was, okay, we've solved for our challenges on the manufacturing side. What we haven't solved for is the underlying business process. And what I mean by that is that we're still doing certain things within the company the way we did 10 years ago, and we don't have to. It's proven to be more difficult to basically peel that back to identify where, should we be touching things 3 or 4 times, or should we be touching them 14 times? Clearly, it shouldn't be 14 times. And so, and where this comes back into capital and cash is we have brought in additional resources from a consulting perspective. The largest one that we're in the midst of right now is with TBM. We actually engaged them a year ago to begin this transformation process. And now we've engaged them even more deeply to become integrated to help us move through this more rapidly. The goal on the other side of this is clearly continuing to create efficiency. And if you look at it's hard to find a comp, right, Paul, to DIRTT, because we are technology and we're manufacturing. There really isn't anybody like us out there. But if you were to go to an Armstrong or a Miller Knoll or anyone else, yes, they're significantly larger than us. However, as a percentage, their SG&A is way different than ours is. So there's opportunity for us there to drive some additional costs out of the business and efficiency, which, if anything, is a bit of a bookend approach to, yes, we have 330 in the pipeline. 2026 is showing up well. Q4 is showing up the way we wanted it to. However, I also want to ensure that if there's anything else that happens from a USMCA perspective, a tariff perspective, that we're leaned out as much as we need to be at the same time without affecting that 400 million in capacity.
Mm-hmm. You talked about the MCA.
Yeah.
How much your business is US versus Canadian? And do you do anything outside of North America?
Yeah. So roughly 70% is in the US,
Mm-hmm.
30% is in Canada. We do have our facility there in Savannah, Georgia. We are fully USMCA compliant. So currently nothing, like the only thing that affect us is the 50% tariff on aluminum, which was the 3.5% surcharge that we instituted that's now starting to show up. It showed up in Q3 and will be fully covered in Q4 from a cost perspective. And so we don't foresee anything else happening, but we also didn't foresee some of the things that happened in Q2. So lessons learned, I don't want to get burned again. And so let's get after driving some additional efficiency through the business whilst we're also not doubling down, but that construction services group is largely already formed. As of today, they can execute about 50 million with the people and the butts and seats that we have to ensure that we don't get over our skis.
Tariffs and USMCA aside, what other challenges or sort of what keeps you up at night right now?
That's a great question, Paul. It's really around construction services and adoption. And it's not for lack of them wanting to. It's just traditional general contractors move so slowly. I need them to pick up the pace, and they are a bit. And we're also forcing it a bit also, right? So, that example that I gave of that healthcare system, they utilize multiple general contractors. We're doing a project with them right now in Florida. And so in a way, it's helping them bridge, when I say them, the general contractors bridge that confidence in, okay, we're in a live ambulatory surgery center that we're building right now that has DIRTT fire rated partitions. It's going to have an operating room in it. Like, it's got all this stuff that is the most difficult to deliver. It's not a commercial office space. That would be the easiest for us to deliver. And by driving that, confidence with them on delivering, but also at the same time, Paul, and I talked about it a little bit 9 months ago, but we're also training them and certifying them to self-perform to do the install, which takes time, right? And so for us, for DIRTT to have a level of confidence with them that they are also capable of delivering on their own on the labor piece of it, we have to deliver these projects together such that then they can go on their own and they're DIRTT certified. And then we go on to the next GC and do the same thing. So that's the one thing that I wish I had more of a crystal ball on when will that inflect.
Perfect. Well, listen, we've got some questions in from some of our audience here. So why don't we tackle some of those?
Sure.
I got a question from Rahil. He says, hi, would you be able to share color on sequential decline in commercial and government revenue, and how should we think about it in coming quarters?
Yeah. So I would say from a commercial, and what was the other?
Government revenue.
Government, yeah. So for us, the decline and if that's specific to DIRTT and what we've seen, right, versus just the macro, because that, to your earlier question, right, why I'm saying it doesn't affect us as much as we flattened out. So as far as a commercial decline, we aren't seeing any commercial decline within DIRTT. In fact, we're starting to see, hence a Google or even CNRL here in Calgary, we're seeing that expand. There's a large opportunity in Toronto. We'll be press releasing fairly soon here as well. That's commercial. So even in Canada and the US, we're seeing commercial grow, albeit low single digits. It's not stalled. It's growing a little bit. On the government side, and interestingly enough, that's actually that project in Toronto is part government, part it's commercial for government of all things. But in the US on the government side, the only project that we lost entirely because of Doge was that FBI project for their headquarters. So that was a couple $1 million hit to 2025. But beyond that, we haven't seen any other losses per se, but we also haven't seen rapid growth in government either. So as we move forward, I wouldn't see much of a change in government or our workplace. Healthcare is growing. And then the other one that will be growing, again, it's a much longer burn, is education. So for all the same reasons I commented on about speed and being open, obviously schools, the other piece of that is we've done quite a bit in higher ed, but K-12 very little because we were just too expensive. And so having this construction services direct channel allows us to compete on all of those K-12 opportunities, which very much align with what that value proposition is. So it's not showing up per se in that 12-month pipeline yet. I would say that's probably more of a 27 where you'll start to see education start to grow faster than healthcare for us.
Awesome. Okay, another question from Rahil. He says, although gross margins increased from 28% in Q2 to 30% Q3, I was anticipating slightly higher margins due to tariffs passed through costs to the customer. Could you please share color on margins for coming quarters?
Yeah. So the pass through in Q3 hadn't quite made it through totally. So there were still projects that we were manufacturing in Q3 where we were price committed for some reason, whether we was contractually obligated. But at that point, when that surcharge came on, that was for all projects that didn't have what we'll call price protection. So we knew we wouldn't be fully covered in Q3. We knew that we would be covered in Q4, which we are. And so you will see gross margins closer to what they have been historically. So even if you were to go back to Q4 of last year, right? And also at the same time, last year when we gave guidance for 20, now I'm not saying this is guidance, but when we gave guidance for 2025 and what that was going to look like, and our comment in our earnings around getting back to more normalized margins, and then for 26 will be likely more similar to what we had anticipated for this year that didn't end up coming to fruition from a top line perspective. So I'd say all those, particularly in using some of those bellwethers, such as the pipeline number as one point of reference, is showing that that should be true. So you'll see us get back to more normalized margins and expansion on top line.
Ben, give us a sense of like what does the visibility look like how long before you get an order do you usually see that recognized in revenue?
Yeah, so it's very close. And that's also part of the reason that we are growing construction services more so. That is a very much longer revenue recognition timeline. For us, when we receive an order from one of our furniture dealer partners, it's a 10-day lead time. So we don't get any revenue recognition from them until they order. So that would be, let's say, for example, it's November 19th, and we're going to deliver a project December 19th. We wouldn't recognize any revenue until today if the order came in today, right? And so not even if it came in today. Let me clarify that. Once it ships, right, then we recognize it. So that would be beginning of December, even though it's delivering in 2 weeks. So it's a very short cycle. With construction services, we would contract up to a year in advance, and we would begin actually submitting draws such that we could recognize revenue even as far out as a year ahead, but then also having the ability to be contractually obligated to that project, even though it's a year out. Then effectively, we truly have backlog, right? Which we currently don't have the ability to recognize that revenue in that method. Which is part of my comment around Q1. Once we start accounting for construction services as its own business unit, you'll be able to see all of that.
Gotcha. Okay. This is a question around guidance. Rahil says, can I assume that your original 2027 guidance can be used as the 2026 target?
The 2025 guidance, yes. For the 2026 target, that's a fair estimate. I think we're a bit more bullish on it, but yeah, that's a safe spot to start.
Perfect. Okay, Jeff asks, your current 12-month pipeline was disclosed at about 330 million. What would be the minimum percent of that converting to revenue in the same 12-month period?
That's a tough one. Thanks, Jeff. And part of the reason it's a tough one is it's not as simple as a quick math calc, because obviously the conversion rate for, let's say, December is significantly more defined than the conversion rate of, let's say, October of next year, right? But on average, you would be in your high 60s of that happening. The other piece of it that's challenging, right, is there's certain projects within that pipeline that are 100%. We know it's happening, right? It's not going to happen until Q3 of 2026, but it could be a $20 million project as well, right? So it is something that we continue to try to find ways to provide better clarity to the market on what does that pipeline mean, what's in it, what is the conversion rate that we can anticipate out of it, for what we know today, and then obviously marrying that with guidance to bring those two things together.
Gotcha. Okay, second part of Jeff's question says, on integrated services, can you outline what problems you solve for these general contractors and how it impacts their profit margins?
Yeah. So it solves many problems for them. It makes complexity easy. And what it does is it de-risks their entire value stream for a general contractor, right? Their risk is around schedule, right? Performance, is the cost, obviously, in cost overruns. Are they buying it out? Is it hard bid? So because DIRTT de-risks all of that, the price certainty is there, the schedule acceleration or compression is there, the quality of construction, 10-year warranty for parts and labor is there, so they're not going to have callbacks. But the labor piece is probably the biggest, and that's the thing that general contractors struggle the most with, and that's why we all hire GCs, is to mitigate the risk associated with the labor that you would traditionally use to build with, in that, are there going to be enough? Are they going to be on time? And when back to, are there going to be enough, right? And so I've used this example before, and I think it'll help visualize it a little bit better. Those airport projects that we're doing for washroom renovations for DFW Airport, we're also doing it at IAH and Houston at Bush Airport. It's not just around, it's an active terminal, so it makes it challenging to do construction to get material in and out. But also, obviously, you have schedule, you want it open as soon as possible. But if I could reduce the overall manpower by the general contractor from 50 people to 10 people, also think about access to an airport, right? So you've got to get past TSA and security. And so all of a sudden, your labor pool just shrunk significantly more. And so now for them, it removes all of that risk from it. And what that also means is it's going to increase their margins, not just on the material because of the price certainty and the lack of callbacks, but more so around how many people are required to manage that. So an average project, right, Paul, is going to have a superintendent, assistant, a project manager, assistant project manager, super, assistant super, foreman, right? Because it's all done offsite and we're replacing about 8 different sub trades. Now you don't need a full super. You can use an assistant super. You don't need a full PM. You can use an assistant PM. So you can start to see where their margins expand just because it's DIRTT, because they don't need the same amount of resources to manage the project.
It's also, I remember the old adage, one throat to choke.
Yes.
You're not dealing with a whole bunch of contractors. You're dealing with one. There's tremendous value in that as well.
Which is why on that Micron project, right? We started with 200K of casework and have ended up with 14 million of partitions, casework, doors. Once they figured it out, the general contractor, it was, we want as much as we can get under your contract as possible.
Yeah, yeah, exactly. Okay, last question from the audience here. It's another one from Rahil. He says, Dodge Momentum Index pulled back in October. Any thoughts there?
Yeah,
First off,
we
maybe explain what the Dodge Momentum Index is.
yeah. So it's an index by a third party that effectively tracks construction starts, architectural design billing. It's a pulse on the market, and you can segment it by vertical. And it's a very good way to determine what's happening, particularly in the United States around construction. And so we track it. In fact, we have our own algorithm that we use internally from a forecasting perspective. And that is one of the inputs from it is what's happening, more so to get a lens into the macro of is there something coming that we should be aware of? As I had mentioned at the beginning of the call, we're so small, we tend to actually go counter to some of those things, also because of where we fall into it. So part of the challenge with that Dodge piece as well is at a given point in time, where does dirt actually land in that, right? And so that's part of what we use it for. But as I had mentioned, it doesn't have as much impact, and we don't use it as much of a guide for what's happening for dirt with relation to construction.
Mhm. Perfect. I should have asked you this question earlier, but it really revolves around capital allocation, and I want to
Yeah,
try to get in your head a little bit. You've announced that you've got an NCIB for your convertible debt. You talked about the sort of the outstanding debt that you have right now. You've got cash.
yeah.
And maybe there's M&A opportunities, I'm not sure, but if we're in your head right now and you've got a bucket of cash, where do you expect you're going to spend it?
Yeah. So there's two things. One, we do still have that second tranche of converts coming due next year in December. Um, and we're not concerned about it. Part of the reason being is we can all things go the way we're anticipating, we just pay it out of cash. It's also cheap debt, to be honest, that's at 6.25%. So it's not always bad to have some debt on the books either.
Mhm.
So some of the capital for that. The other piece is also ensuring that if one of these large projects takes off with one of our construction services opportunities, and we need to build a factory in the United States or in Mexico or other, we have the ability to mobilize rapidly. And again, we're not talking, $50 million factories here, right? This is
Mhm.
something much smaller, which is also part of our corporate strategy, right? However, all that being said, we are in a bit of a wait and see with where we end up at the end of, we'll say, Q2. So, and ensuring that all of our projections come true, then we'll see where that goes. And, at the end of the day, yes, we have the NCIB, we've done a SIB. We are very much trending towards trying to be more of a shareholder friendly company, right? And, you know, reducing dilution is good for everybody, right? So
Mhm.
there's an opportunity there. You're right as well with some M&A things. We'll see where that goes. But again, a little bit too soon to tell with what's going to happen for 2026.
Mhm. I asked you earlier sort of what keeps you up at night, but what gets you up in the morning? Of all the new initiatives and things that are going on, what gets you the most excited? What gets Ben the
Yeah.
most excited right now?
The same thing that keeps me up at night. um, yeah, probably the thing that gets me the most excited, one of them is that fire rated demountable partition. And why that's such a big deal is there's nothing else out there. It doesn't use any drywall, and it opens up a huge, larger addressable market for us that we couldn't pursue before. So even that operating room that I was talking about, some of the details that, excuse me, the AHJ, which is the jurisdiction that oversees that from a regulatory perspective, that signed off on it. That's one piece of other pieces, and that rated partition is another piece of other pieces, such that if we want to expand into, like when I was talking about education, that's not just classrooms, right? That's also
Mhm.
multifamily. So we're talking dorm rooms.
Mhm.
Um, we could never participate in those because we didn't have a rated partition. So similarly to that Micron project, but for different reasons. And I may or may not have shared this 9 months ago. There's a pursuit in California that we're after for a large university there. So it's not even K-12; it's for higher ed, but they're building, a 10-story dorm room, and for them, the faster you can build it, the faster it can get open.
Sure.
But for us, historically, that could have been about a $200,000 opportunity, mainly on the main floor. So, common areas, some casework, amenity spaces, a little kitchen or something. By being able to have a fire rated partition, that opportunity is now $22 million because now we can do every single partition throughout the building. We couldn't do that before. So
Right.
that's what excites me is the innovations that we're making are multipliers for how we grow this thing faster. If we had done nothing with construction services and we had kept the business model that was in place and continued to refine it, yes, we've proven it can be profitable. Yes, it grows, albeit single digits. However, the upside is limited, right? There's a limiter there through our furniture partners. All of these things allow us to basically go at light speed into these other addressable markets. That's what gets me up in the morning.
Perfect. And then advice for us investors that are paying attention. What do you think are the catalysts or maybe potential catalysts that we should pay the most attention to in the future here?
Yeah, so I'd say continue to keep an eye on construction services in the earnings. Q1, you'll be able to see profitability for it. I'd say those are two critical things. You'll also see a revamped, we'll call it comms strategy, external to the markets around things that are happening, such that at a minimum, once a month, there's a press release coming out about something that's happening around all the things we just talked about, whether it's a specific win with a customer, whether it's an innovation, things that are meaningful enough, right? But meaningful enough that we shouldn't wait until an earnings release to just kind of pile it all in there, such that there's better communication with the investors around what's happening to also increase that confidence such that we should see the share price move more rapidly.
Fantastic. And lastly, is there anything that we missed? Or if we didn't, is there a key message you want to make sure everybody walks away with today?
No, I think we touched on pretty much everything. Um, I'm happy to similarly, anybody that wants to come visit, come for a
And
ski
by the way,
trip
I
and talk
highly
to me.
recommend anybody that gets that opportunity to do come visit. It's an amazing facility, and the amount of innovation that's going on there was stunning. From somebody who used to work in the construction industry, I was really impressed with what I saw. So if you get that opportunity, definitely take Ben up on the offer.
Yeah, so I'd say that and just you know, keep an eye on our SG&A. I think that we will see some pretty remarkable things come out of our transformation process. So I'm pretty excited about that. It's one of the things that we've navigated through over the last, call it year and a half in earnest around construction services is doing business differently. And
Mhm.
what does that look like back of house? So the things you guys don't see. And seeing those two things in conflict in the last month, all of a sudden see them mesh together such that now we have a more seamless process where shared services are touching at the right time in the right places now allows us visibility to see, okay, there's way too much going on here and way too much going on here, such that we can lean out the model without affecting any of the value prop or the customer experience, if you will, such that we can, as I commented, get, I'd say, more aligned to any of our other peers and what our cost basis looks like.
Mhm.
Yeah.
Fantastic. Listen, Ben, thanks so much for joining us. We have been speaking to Benjamin Urban, CEO of DIRTT Environmental, symbol DRT on the TSX. It was nine months or so since we last spoke. Hopefully, we can catch up sooner than that next time.
Yeah, let's do that. I look forward to it.
Awesome. Thank you so much, and bye for now.
All right. Thank you.